The accounting equation and its elements. Financial statements are based on the accounting equation. The accounting equation shows the relationship among assets, liabilities, and owner's equity, and is shown as assets equal liabilities plus owner's equity. As pictured here, assets appear on the left side and liabilities and owner's equity on the right. As with any mathematical equation, both sides must be equal. Thus, if assets are $1,000, then the combination of liabilities and equity must also equal $1,000. In this case, $600 plus $400. How do we arrive at the financial statements? Let's examine the elements of financial statements, which are the building blocks on which these statements rest. The accounting equation represents the resources of a company and the claims to those resources. Assets are the economic resources that are expected to produce a future benefit. Claims on assets come from two sources. Liabilities are outsider claims. They are debts that are payable to outsiders called creditors. They will require some future sacrifice or payment. Owner's equity, also called capital or stockholders' equity for a corporation, represents the insider claims of a business. Equity means ownership. In the corporate setting, it's the stockholders' interests in the assets. There are many assets a company might own. Examples of just a few include cash and cash equivalents, receivables, supplies, which are items the company uses on a daily basis, inventory, and property, plant, and equipment, or fixed assets. Liabilities include a number of payables, such as accounts payable, wages payable, and federal and state income taxes payable. The word payable always signifies a liability. Also included as liabilities are long-term debts and the current portion of those long-term debts. Although only briefly noted here, most of these assets and liabilities will be discussed further in a later video. Then there's owner's equity. If we take all of the assets and subtract off the liabilities, we are just left with owner's equity. For a corporation, the owner's equity is called stockholders' equity, which is comprised of two parts, paid-in capital and retained earnings. Thus, the accounting equation can be written as assets equals liabilities plus stockholders' equity, or assets equal liabilities plus paid-in capital plus retained earnings. Paid-in capital is the amount the stockholders have invested in the corporation. The basic component of paid-in capital is common stock, which the corporation issues to the stockholders as evidence of their ownership. All corporations have common stock. Retained earnings is the amount earned by income-producing activities and kept for use in the business. Three major types of transactions affect retained earnings. They are revenues, expenses, and dividends. Revenues are inflows of resources that increase retained earnings by delivering goods or services to customers. For example, selling a pair of jeans brings in revenue and increases retained earnings for a retail store. Likewise, providing landscaping services for a customer also brings in revenue and increases retained earnings. Expenses are resource outflows that decrease retained earnings due to operations. For example, the wages that companies pay employees are an expense and decrease retained earnings. Expenses represent the costs of doing business. They are the opposite of revenue. Expenses include costs of goods sold, building rent, salaries, advertising, and utility payments. Expenses also include the depreciation of computers, vehicles, and other equipment. Dividends decrease retained earnings because they are distributions to stockholders of assets generated by net income. They are usually paid in cash. A successful business may pay cash dividends to shareholders as a return on their investment. But remember, dividends are not expenses. Dividends never affect net income. Instead of being subtracted from revenues to compute net income, Dividends are recorded as direct reductions of retained earnings. To review, revenues increase retained earnings, while expenses and dividends decrease retained earnings. This chart shows the relationship among the following: retained earnings, net income, and dividends. At the beginning of the period, we have the beginning balance of retained earnings. Net income is then calculated as revenues minus expenses. If the result is a positive number, then net income is added to retained earnings. If the result is a negative number, then a net loss is subtracted from retained earnings. Then dividends are subtracted, and the end result is an ending balance in retained earnings. Let's take a look at an example. Blue Diamond Corporation has current assets of $160 million, property, plant, and equipment of $600 million, and other assets totaling $220 million. Current liabilities are $110 million, and long-term liabilities total $460 million, with $45 million in common stock. Using this information, let's write out the accounting equation, determine the resources available, determine the amounts owed to creditors, how much of the assets the stockholders actually own, and how much in retained earnings the company has. First of all, the accounting equation is assets equals liabilities plus stockholders' equity. Blue Diamond's assets are their current assets of $160 million, property, plant, and equipment of $600 million, and other assets of $220 million, for a total of $980 million. The liabilities are the current and long-term liabilities of $110 million and $460 million, totaling $570 million. When we subtract 570 from 980, we arrive at stockholders' equity of 410. To answer the rest of the questions, assets are the resources of the company. Thus, Blue Diamond has $980 million in resources, owes $570 million to creditors, and the remaining $410 million are the stockholders' claims, or the amounts they own. For our last question, hopefully you remember that stockholders' equity is comprised of both common stock and retained earnings. If the company is issued $45 million in common stock, how much would they have in retained earnings? Well, we merely subtract the $45 million from the 410 to arrive at retained earnings of $365 million. And that concludes this podcast on the accounting equation and its elements.